Thank you, Poonam, for delaying the panel by 20 minutes or 25, is it? But thank you very much for inviting us. And I think this is an extremely high-powered panel, bringing together a lot of things that have been said, but we are bringing it to a panel with some sense of urgency and immediacy. The title says it all, India's economic prospects in a turbulent world. So we want to hear the estimates of, or an estimate of India's economy and economic growth in the next few years from these experts. Now, the debate of India's economic growth and its trajectory has been somewhat hijacked by the Prime Minister putting this, goal in front of the nation that you have to be an advanced nation by 2047, the centenary year of our independence. So that's kind of hijacking all the arguments on economic growth. I wouldn't have given it much credence, except that the Reserve Bank put out a research paper after that in last year's July bulletin, where they said the IMF classifies advanced economy as $30,351 per capita. The World Bank classifies a high income as 21,664. Now, if India's FY24 per capita income is about $2,500 to $2,600 per capita, then the research paper says India needs to grow at 7.6% for 25 years to reach the goal of a high-income country by FY48, 2047. This is just arithmetic. Reserve Bank is not indulging in any forecasting. Now, how feasible is that? I'm quoting Sajid Chinoy's paper in Indian Express, where he says only 13 countries have achieved 7% plus growth for 25 years. And 9 of them have been in Asia. Most of them, as we know, Japan and the Asian Tigers did it between mid-60s and mid-90s. And China was the one that achieved 22 years of 7%, actually even double-digit growth in some years. That was from 1990 to 2012. So the question we would be asking is, can the current global context permit India to be one of these high-growth nations, because it is already the fastest growing large economy. Now, for this, the last table is mine. I looked back, if you want to grow for the next 25 years by 7.6%, what did we do in the past 25? So this is, again, plain arithmetic. In the past 20 years, that is from FY05, that is 2004-05, to FY24, the average is about 6.4 something. We can round it off to 6.5 at best. The average for 25 years, which is if you start from FY 2000, then that comes to 6.3. But if we go back 40 years, then that is 1985, 84, 85, which is when we went past the Hindu rate of growth and growth started picking up. Even then, the average is 6 per year. So there's something about this 6 and the 6 handle. It is so much a part of our trend rate of growth. If we have to make it 7.5, that's 1 full percentage point more. That requires a structural shift. So my questions to the panel would be, first, the original question, which Martin Wolf will be answering. What is the global context? Is it as good as it was when the Asian Tigers could grow by 7% for 25 years? And what about India itself? And that's for those who are studying India as their area of expertise, the CEA included, Barry included, Swami Iyer. What kind of structural shifts? And even if you don't, let's not allow this 2047 Viksit Desh to hijack all rational arguments. What I'm asking is, if the past 25 is 6.4, then how good can we be going forward, say for the next 10 years? Because we have the coming together of a few things. We have the demographic dividend. We have, India's export growth, services exports becoming feasible because of telecommunications and IT. And we are told once an economy goes beyond $2,600 per capita, it is able to produce greater tax to GDP. There are more taxpayers. The experience in many countries has been that in some cases, tax to GDP rises even by 4 to 5 percentage points. So we have seen that in the last 2 years, our tax collections have been way above budget estimates, which is a rarity in India. We always collected less than budget estimates, but last 2 years we collected more than the budget. So I'm just asking the panel whether we have that also as a positive coming, the virtuous cycle of higher tax to GDP. That's the question. What kind of higher growth can we expect compared to the last 10 or 20 years, and why? Over to Martin Wolf first.
Okay, it's a great pleasure to be here. I've learnt a lot, not notably about Punjab, which was absolutely fascinating. What I'm going to do, and I'm not sure I'll get through it all, and I might just junk the last part, depends on how it goes, because I have some overlap with what you've already heard from Pierre Olivier yesterday. That was an inevitable risk. But the main thing I'm going to focus on is my perceptions of the global context, the long run, the longish run global context, because if I have a comparative advantage at all here, that's clearly where it lies. I'm not going to contribute anything on India that you don't know about infinitely more than I do. The general perception of the world economy I gave last year, when I had, I think it was last year, everything blurs at my age, my own T.N. Srinivasan lecture on what I thought of as the world economy. And the only thing I would say is whatever I said then, it's worse. But this is what I'm going to try and do, and I have a number of points to make, and I even have one chart which is rather worse than, but essentially the same as Pierre Olivier's. But then I don't have the entire IMF to be my research assistant. I am going to start with the Prime Minister's commitment because I think it's an interesting commitment, not because I think it's likely to happen, but it gives you a frame of what could happen, and it has some quite important implications because I'm not going to go into detail, but if this were achieved, India would become an enormously much bigger part of the world economy than it is today. If you really think it were achieved, it could become, under plausible assumptions, which I'm not going to in detail, close to a quarter of the world economy. And that will be a different India and a different world. And I can't explore that in detail, but because India is India, it would, if it achieved this, which is pretty close to what China achieved, become a factor in the world economy pretty well like China's today, and that will be interesting. One of the things you can take for granted is at some point in that process, you would be America's enemy. That is an absolutely serious comment. It is not a joke. Now, it might occur quite easily. So I'm going to talk about India's aspiration. I'm mainly going to talk about the global slowdown. I will, if I have any time, talk briefly about India's choices and then a conclusion. And I apologize that there isn't quite a bit of overlap. So the first, is it the goal of becoming a high-income country by 2047 plausible or feasible? How would this compare with what China did? And I'm looking at this in a slightly similar way to what you've just heard. So this is the objective, and I thought I'd do it in a nice concrete way, not an abstract way. So it turns out when I looked at it that the poorest advanced country in IMF definition is Greece. And so basically the per capita income of India in the next 23 years or so would become that of Greece today, which, by the way, since it's improved quite a bit recently, isn't so bad. It'd be quite a big change. Today, according to IMF statistics, GDP per head at PPP, which is, I think, the best way for making comparison, is a quarter that of Greece. If India's GDP per head grew at its 1990 to 2029 trend rate, using IMF forecasts, because, of course, the IMF is always right. Actually, it's just the trend. And Greece's GDP did the same, which was terrible, then India's GDP per head, this would be about two-thirds of that of Greece in 2047. I don't know why that disappeared. To catch up, India's trend rate of growth of GDP per head would need to rise from about 4.8%, which seems to be the fitted trend on the last 30 years, to 7.5%, which is roughly consistent with what you say. GDP per head rising at 7.5% for India, given population growth will be slowing a bit, is way up in the 8 to 9% range. That is, how does one put it, ambitious. So this little chart shows what it would mean. The green line is Greece fitted trend, and the purple shows what a unhappy time Greece has had. The blue line at the bottom is India's trend from 1990, and that's 4.8% a year. The blue line shows what would happen if India continued on that trend to the to about 2050, 2049, at which point it will be close to two-thirds of Greece. And the dotted line shows what would have to happen. There would, in other words, have to be a massive acceleration. So it wouldn't be a trivial thing to achieve, to put it mildly, and I'm not going to say any more about all of the things that would need to happen for that to be achieved, but it wouldn't be business as usual. That's pretty obvious. And what is striking to me is how consistent the trend growth, all things considered, has been since the reforms of 1980, which is shown by the fact that you can hardly even see India's actual GDP behind the trend line. It's a new Hindu rate of growth, rather a better one than the old one, but it still is. So we can say at the moment, at the moment, its GDP per head relative to the US is forecast to triple over the 4 decades from 1990 to 2029, including the IMF forecasts. But China's is forecast to rise tenfold. So moving up to this faster growth involves moving to something really vastly more exciting. And this is what these last 40 years have meant in comparing China to India, and this is what the future for India would look like if it's going to get up to the comparisons with Greece that I mentioned. But it is worth noting that even so, on these figures, India's GDP per head has risen 3 times relative to US levels between 1980, this goes back to 1980, to the forecast 2029, which is a terrific achievement, which no other large developing country apart from China has matched. So this is already a pretty good performance. Now, the key point in terms of the global economy part, which I'm going to talk to, that even if it sustains the present current rate of growth with allowing for population growth, it would plausibly, over the next 20, 25 years or so, be growing twice as fast as the world economy. Just continuing current trends, and that's a big deal because it gets bigger. It would be changing more markets. It would have reactions. It would have to change its market penetration, diversify. It's a big deal to grow twice as fast as the world economy for a country as big as India over this period. And that leads me to the second and much more important section, the global slowdown. And I'm going to look at what's happened, why the slowdown has occurred, and this is the really key point. We are in a significant global growth slowdown. And the way I've shown this, because I like very primitive charts, is to take a 10-year moving average of growth rates, all from IMF data, of GDP in constant prices, growth of GDP in constant prices. And this one shows at the bottom the advanced countries. Above it is the world, that's the red. Above that is all emerging markets and developing countries. And above that is emerging and developing Asia. And there are 2 general points to make about this. The more detailed points are made in the text, which I won't repeat. You can read it. But essentially, there has been, and according to the IMF, which is always right, continue to be a general slowdown in GDP growth. And it's quite a big slowdown. And for the advanced countries, basically growth rate has pretty well halved since the peak before the financial crisis. For the world, it's gone down for over 1 percentage point. And there is a particularly striking decline for the emerging Asia and also emerging and developing countries. And I'll come in a little while to what I think is the biggest single determinant of that. I should point out these are 10-year moving averages, and the date I've used is the end year. So if you look at any year, what you're seeing is the average of the previous decade, and what it brings out is that sometime between 2008 and 2012, we reached a peak from which quite generally there has been a very significant decline. In the case of the Asian emerging countries, the decline over these 10-year average growth rates goes from well over 8% to about just under 4%. It's a dramatic slowdown. And the slowdown of emerging Asia is, I think, the biggest deal here. Now, this looks at GDP per head, which is sort of a good measure of a simple measure of economic welfare, and you can see a very similar phenomenon. GDP per head growth on average, 10-year moving average, for the developed countries is close to halved. For the world, it is not done very much better. It's gone down by about a couple of percentage points. And again, for emerging Asia, still the fastest growing region in the world, it's also been, including the forecast, a very large decline, and the IMF believes this will continue, this sort of deterioration in performance will continue throughout the rest of this decade. And these figures are obviously very big and important. Okay. Now, one of the implications of this, when you look at these figures more carefully, is that the catch-up, on average, weighted average, obviously weighted by country size, this is not an average of country growth rates, it's a weighted average, there has been a very significant slowdown in the catch-up rate, and is forecast to be from its peak in the decade leading up to 2012, and 2012 is significant. In my view, it's a more significant year for global growth than 2008, which we focus on, because it is the year when China's growth rate really started to slow. And it was a decisive moment for global growth. And that's continued now. China's growth rate over this period has basically gone from 10 to about 4. That is the biggest single change here. But you can see that the gap between the growth rates of all emerging market and developing countries and emerging and developing Asia and GDP per head and that of the developed countries, though still large, has very, very substantially diminished on a weighted average basis. Okay, now I'm going to look at a few important emerging economies just to show where India fits in. And I was sort of a bit surprised by this when I did this work. It's basically the same process I've done before. These are the 7 largest emerging economies at PPP. I've gone up to 2029 in the same way. You won't be surprised that the one at the top is China. Red is China. The light blue is India. The dark blue close to it, and the dotted line are Turkey and Indonesia, which are the closest to it, and then we've got the disasters of Russia, Mexico, and Brazil. The key point here is, one, to underline, India's growth has been remarkably stable. There has been a small slowdown on these figures of about 0.5 percentage point or so, and most crucially, we are now moving right now to a period in which the average growth rate of India, if you believe the GDP statistics, is over the last 10 years and continuing to the end of this decade, if the IMF is right, significantly higher than China's. So China is now, in the aggregate growth, India has now moved quite credibly into a leading position, not because it is doing better than it used to, it very clearly isn't on these figures, but because it has sustained a very stable growth rate when others have done rather worse, especially China. Now, This is the same chart essentially for GDP per head growth, which is more important for welfare. India obviously has significantly slower growth of GDP per head than GDP because its population is still growing. That's not true for China. But the result is that even for GDP per head, India will emerge as the fastest growing over a sustained period by the end of this decade. So for the 2020s, again, maintaining just with the GDP growth, a very, very stable 4 to 5% a year. And if that were to be sustained over the next 20, 25 years, we would be looking, as I've already suggested, it's a very different world. This also brings out the fact there are a lot of large emerging countries that are close to stagnant and not catching up at all. One of my favorite or least favorite statistics when you look at is Brazil's GDP head and Mexico's GDP per head relative to the US is essentially the same now as it was 40 years ago. There is no catch up at all. Okay, then of course, and this is the thing that I share with Pierre Olivier, there is the question of I've just talked about growth, what we can see about growth. I haven't gone into can't go into what's driving that yet. I'll come to that in a minute. But another aspect of the period of very fast growth that we saw is what Arvind Subramanian calls hyperglobalization. And the IMF, I think, invented the word slowbalization. And we've moved clearly from one to the other. This is trade in goods relative to global GDP, and I think I've added 60 years to your chart. It goes back to 1800, and that brings out a little bit better the great globalization upswing of the first globalization, the period up to the First World War, then the total collapse, then the incredible rise of the post-war period, which Pierre Olivier discussed so very well. And since then, it's basically stabilized. So what we can say, I think, that growth in merchandise trade there are all sorts of problems about the measured value added, it's as though it's roughly in line with world GDP. So if world GDP is going to grow at 3%, it's a reasonable guess, unless something very dramatic happens, that world trade in goods will grow at about 3%, unless it falls over a cliff, which seems to me off a cliff because Donald Trump really does impose his trade war, in which case it's going to be worse than that. But I can't see anything going on at the moment that's likely to make it much better. I'll come to this in a second. I think that's a reason, and then something follows from this, which is very important. If India is going to grow twice as fast as world GDP, either its exports grow twice as fast as world GDP for a very, very long period, or its trade ratio consistently shrinks over a long period, and that's important. That's important, I think. If you're going to grow much faster than the world for a long period and you're a big economy and you want your trade ratio to remain constant, then your trade relative to world GDP has to grow very consistently. And that has some requirements and implications. The other chart that I think is very useful and which I can't remember whether Pierre Olivier had anything like this, is what happened in services. And he makes the point, I think, a bit more confidently than I would from these statistics, that it looks as though world service trade has not slowed down as significantly as merchandise trade. Now, I won't go into all the details of this because I clearly don't have time, but it's not clear that it's as good as all that. These statistics are a little old. It's from a very recent paper, though. But it does look as though world service trade is holding up somewhat better than world merchandise trade. And that is important for India because it's pretty clear that it has a stronger comparative advantage in services than it has in manufactures. And at the moment, it doesn't look as though anything is likely to change that. But its share in services is larger. But as has already been pointed out, the share is still quite small. And that leaves, one hopes, room for improvement. Now, the only other chart, which again overlaps a little, is what does the block formation mean for trade? And this is a chart which is complementary to some charts that Pierre Olivier had, but it comes from another source, the WTO, in fact, and they have constructed, obviously, a statistical exercise, the blocks of the world, and it shows within blocks and between block trade, and with an index, it's in dollars, so it's in value, it's indexed to trade at the beginning of this decade, if I remember, 2021, and it does seem to show well, what it does show is that trade in goods between hypothetical East and West blocks has grown 4% slower than intra-block trade since the start of the war, which is 2022. Interestingly, that they conclude that they don't see increased regionalization as a particularly important phenomenon. So friendshoring works more than nearshoring, which I think is consistent, if I remember correctly, with what you said. And that's, I think, quite interesting, has implications for India, which I'll come to in a moment. So why has this growth slowdown occurred? This is the key thing. Well, first of all, in my view, because an awful lot of us, I don't think I was quite as guilty as others, but I was guilty of thought that the growth in the world economy before 2007 was a trend and not a bubble. So we didn't know what the trend was. Very important. Second, we've had a whole series of shocks, which with luck will pass: the global financial crisis, its aftermath, and more recently, of course, pandemic, the inflation shock, and war. And all things considered, which is very important, I think, given the scale of the shocks, which in my discussion last year, we haven't done that badly, which is part of the reason why I'm so puzzled by why so many people are so miserable. But that's another question altogether. We have, I think, consistently exaggerated the benefits of recent technological progress as a consistent trend. I'm very much in Robert Gordon's side on his view of how significant the technological progress into the digital economy has been for our economies as a whole. And I've been pretty consistently skeptical about that. Doesn't mean it hasn't been important, been very important, but not as important as all that. And I am equally skeptical about AI. But anyway, I think there's pretty clear evidence that we haven't got as much out of this as we thought we would. Rising uncertainty, which we've discussed, which I think is very important. Worsening policy, which the IMF has discussed very, very well recently, which there's plenty of tendency. Deteriorating in openness to trade, which is definitely there, and associated uncertainty with that. And crucially, China's deceleration, which in significant measure is a choice, in my view, not an inevitable destiny. And it's an important question whether that's over. So those are my reasons for the slowdown. Now, if you think of that's the past, let's look at the future. Why might we be optimistic that, despite my general pessimism about this, it might turn out to be better than the IMF thinks? Why might there actually be more dynamism ahead than most people now expect? And I have three reasons which might be of interest. The first is, well, we've had a whole long series of shocks. You tend to think of these as slightly random and unpredictable events, but we've had 4 pretty damn big ones in 15 years and 3 in just the last 4. Well, maybe we're just going to have a nice peaceful time, which, why not? We have had long peaceful times before. Think of the 90s after the Iraq War. The second possibility is I'm completely wrong about technological change. AI, etc., is going to bring a new, fantastically accelerated rate of productivity growth worldwide, which we can exploit. And third, that governments will suddenly realize that they've been seriously screwing up policy on multiple directions, including trade, and they're going to see the light and come back to the old Jesus of good policy. I wouldn't bet much on that, but it's possible. One of the reasons for pessimism Well, climate change, which I wrote about, unabated, getting worse, and in my view, likely to get dramatically worse. Yep. Demographics, aging and sub-replacement fertility rates in both high-income and upper-middle-income countries. Aging countries just have big problems in managing rapid growth, and the fiscal pressures associated with this are big, and they're not just in developed countries. And a whole slew of global fragilities, high indebtedness, great power competition, global economic fragmentation, partial diminishing cooperation, and even threats of war, decay of liberal democracy, rise of nationalism and reactionary populism, and fierce opposition to necessary economic reforms everywhere. And my view is, I'm afraid, the pessimism wins. But if you're an optimist, good luck for you. Maybe you're going to be right. Now let me then, in the last 3 minutes, what might all this mean for India? So the global environment has changed fundamentally. It is more dangerous and chaotic than at least prior to 2007. That clearly creates huge risks. But it also offers some important opportunities, perhaps uniquely for India. It can really try to be a connector. It can form useful and productive economic relations with all sides, because really, if China loses India too, that's not a great place to be. It could, if it tried, partially replace China as a competitive global supplier of goods and services. At least at the moment, the US really likes it. It could become a magnet for foreign direct investment for the same reason, and it can and could be a significant positive influence on global debates. And I argue as it gets bigger and bigger and more important, it can try to shape global debates. There are very few other countries with the capacity to do so on its scale, particularly its position in the global south. It is important, however, that in my view, that India should not turn away from world trade. It has substantial assets in seeking to shape the world to its advantage. It's an obvious plus one, as I've already said. It has good relations with the West. The Indian diaspora is enormously successful, which does give it leverage in America, and may it last. India's size gives it the resources to diversify and upgrade its economy. And so what I'm going to conclude with this, that my basic point here is it makes sense for India to try to avoid, and Arvind discusses this at length, but I won't go any further in, trying to avoid a collapse in the trade ratio. The rising trade ratio has closely correlated with its improved growth. It's become very difficult to see that it's not doing very well, but it hasn't collapsed. I think there's a very good reason to believe that trade opportunities remain important for India, which means that the trade ratio should, this is a simple statistical measure, I know, but the trade ratio should not be allowed to contract dramatically from what is not an extraordinarily high level for an economy of this size, at least for the moment. The growth of trade, therefore, should exceed the growth of GDP. Trade policy domestically and its role in trade discussions globally should take account of that priority, which is one of the many that I think will have to be satisfied if India is to continue to grow at anything like the rates we've been talking about in a world which unambiguously, I think, on balance, is going to be difficult. Thank you for listening.
Yes, on time. Yeah, absolutely. Dr. Gurinchas.
Thank you.
8 to 9 minutes.
Yes, thank you very much. So first, of course, as Martin has mentioned, there is some significant overlap between the themes I talked about yesterday and what he covered today, but that is not a coincidence. I think this also reflects a sense in which there is a very broad alignment in the way he's thinking about these issues and the way we have been looking at them at the fund. But in my remarks here, let me organize them around 2 themes, and then dig a little bit into each of them. So the first one is about the global economic outlook and the medium-term prospects, and I will offer some complementary thoughts on this. based on what Martin has presented. And then I want to touch on some of India's priorities in the context of how India is evolving. So on the global economy, I will basically make 3 quick points. The first one is resilience. Resilience, I think, needs to be emphasized because we have a global economy that has experienced a one-in-a-century pandemic that was absolutely global. Everyone was hit. That was followed by an inflation surge as economies reopened. Then the consequences of an important military conflict, Russia's invasion of Ukraine, that had a very significant impact on energy prices and food prices. And despite all of this, we haven't had a global recession. We haven't, I mean, there was, of course, the lockdown period in the immediate first stages of the pandemic, but as the economies reopened, we haven't had a global recession. Despite the surge in inflation, we haven't had, up to this day, uncontrolled wage price spirals of the kind that the world has experienced when it was hit by significant energy price shocks in earlier decades, in particular in the 70s. And so I think it's important to emphasize that the global economy has been able to handle these shocks, and of course it's been painful, but it's handled them fairly well. Now, one of the reasons we think, when we look at this at the fund, one of the reasons we think that the global economy has been quite resilient is in part because of improved frameworks. What is really striking, if you look at the last 2 years, is, if you roll back the clock and you'd ask me in December 2021, the Federal Reserve is about to hike interest rates by 500 basis points. The European Central Bank is going to do something of the same order of magnitude. The Bank of England is going to be doing the same thing. What do you think, based on your knowledge of economic history and previous episodes, what do you think will happen to emerging market economies? And I think most of us trained in international macroeconomics, most of us who had looked at previous episodes would have said, with very, very little variation, there's going to be a bloodbath. It's going to be just impossible for emerging market economies to withstand the pressure. There will be capital flight, currencies will collapse, there will be a lot of loss of confidence, there will be instability, and there will be major recessions in many of these countries that will face sudden stops. And that has not happened. This is the part of the resilience that is quite remarkable. And so when I say improved frameworks here, what I mean is that when we look back and try to understand what's been going on, is the fact that many of the emerging market economies, and that goes for India as well, of course, have improved their monetary policy framework, have improved their fiscal frameworks, have built buffers, have built resilience, and have also let some of the adjusters operate. For instance, have let their currency depreciate and absorb some of the shock when the Federal Reserve and other major central banks were tightening. And I think that flexibility combined with better institutional frameworks has helped anchor inflation expectation, has helped weather these shocks much better. Now, this doesn't mean that of course there is a lesson there, and there's a lesson in terms of preserving also going forward, preserving that resilience and preserving that kind of institutional strengthening that has been happening. Here, one of the things that we worry about when we're looking around the world is the extent to which central bank independence, for instance, or central bank ability to operate and do what is needed in situations like this might be coming under threat for a variety of reasons. Of course, it's never pleasant when central bank increase interest rates. That's one side of the ledger. Another side of the ledger is sometimes central banks are asked to do too much in areas that are not directly related to their operational mandate. So this strengthening of framework has been very important. Now, that's sort of the good side. The worrying side, when we look more at the medium term, there are two of them. Both of them have been mentioned by Martin. I want to echo his remarks here. One is the dimming prospects for medium-term growth. This is something that we spent quite a bit of time. We had a whole chapter in our latest World Economic Outlook in April that looked at that. And this is something we try to unpack it. So we tried at looked at as economists try to write down what the production function look like, and try to look at the different buckets. Is it coming from aging population? Is it coming from lack of capital formation? Is it coming from declining productivity? And if it's declining productivity, what can we say about that? Because productivity is often just the part that is unexplained. And the answer is that it's a little bit of everything, but it's not just the demographic forces that are at play. We have a weakness in investment, and we have weaker productivity growth. And when we look deeper at the productivity growth, we did a very useful exercise there. We tried to measure, get a sense of what we call allocative efficiency, so the extent to which resources within a country are allocated in the right place, whether you have the right combination of labor and capital and recipes, if you want, to produce output, or whether resources are distributed in the wrong place. And that measure of allocative efficiency, which is building on the work that has been done more than 15 years ago by people like Cheng Tai-Shih and Pete Klenow, have worsened in most parts of the world. So resources are increasingly less efficiently allocated within countries, and that is something that is especially true for emerging market economies, and I think that's something that we should keep in mind. That's something that is a concern going forward, but there is no law of nature here in terms of the decline in productivity growth. I mean, of course, there is what we call catch-up convergence. Of course, we expect that at some point emerging market economies will see the growth rate slowing down as they get closer to the frontier. But for most countries, that slowdown is happening well before they're close to the frontier. So it's not driven by catch-up convergence. And therefore, it means that it's something that can be addressed. We can think about policies to improve growth prospects. The last hurdle that we're going to be facing, I'm not going to expand on this because I've talked at length about it yesterday, of course, is fragmentation. Now, let me turn to my second remark on India's prospects. So I'll make basically three observations here. The first one, again, echoing what I said yesterday, silver lining. In this challenging environment, there are opportunities for countries like India to find their space and grow in that space and maybe benefit to some extent, everything being relative. It would be better for the world as a whole to be less fragmented. But within that environment, it's not like there are no opportunities for countries like India. Now, two more quick remarks. One is on the near term and one on the medium term. In the near term, when I think about the positives for India, I see two of them. One is the push on public infrastructure. I think this is absolutely critical, and I think there is a lot going on in that space here that is going to help India become a more productive economy. Infrastructure is key to a lot of the things that need to happen. And in particular, digital public infrastructure. I think India is really at the vanguard here in terms of digital public infrastructure in a way that the rest of the world can really look at what's been happening, the way it's been deployed, and take lessons from that, both emerging market economies, low-income countries, and advanced economies. Final point is on the medium term. Medium term here, I want to make three, in bullet points, three remarks. The first one is it's going to be absolutely critical to rely on the external sector. It brings a discipline, it brings knowledge, it helps facilitate catching up to the frontier. I think any strategy for a country like India that would be inward-looking would be a terrible mistake. I think more needs to be done to facilitate foreign capital coming in with foreign knowledge and technology. More needs to be done to allow Indian firms to access export markets, and in turn that means also allowing Indian firms that need to produce using foreign inputs to access those inputs. Second is that in this more challenging world, the South-South trade is going to become even more important than the North-South trade. We are seeing the walls being erected in northern countries, but there is a lot more that can be happening in the South-South trade. Final point, domestic market integration. India has an enormous advantage compared to most other economies, which is its economic size. And here, what that means is it can rely on the huge scale at which it can operate domestically. So it's not a choice between domestic development strategies and foreign-oriented development strategies. One reinforces the other. And I think from that perspective, making sure that there is really a single market inside India, reducing barriers to the flow of factors, capital and labor and innovation is absolutely critical. I'll stop here. Thank you.
Thank you. Well,